Building a defensive investment strategy for volatile times is one of the most important steps you can take to protect your financial well-being. While the allure of high returns in bull markets is strong, history has shown that markets inevitably move in cycles. Downturns, corrections, and even outright crashes are an unavoidable part of the investing journey. Yet, with the right approach, you can weather these storms and even emerge stronger on the other side. To begin, it's essential to understand the nature of market crashes and why they happen. Markets are driven by a complex interplay of economic fundamentals, investor psychology, and external forces such as geopolitical events or technological disruptions. Often, crashes are preceded by periods of excessive optimism, what economists call bubbles, where asset prices become disconnected from underlying value. As prices soar, more and more investors pile in, fueling the fire. Eventually, reality sets in. Perhaps it's triggered by a disappointing earnings report, a sudden policy change, or a shock from abroad. The result is a rapid unwinding, as fear replaces greed and investors rush for the exits. Recognizing the warning signs can help you prepare. Some of the most reliable indicators of trouble include an inverted yield curve, a sharp rise in margin debt, and euphoric speculation in risky assets. For instance, when the yield on short-term government bonds rises above that of long-term bonds, it often signals that investors expect economic trouble ahead. Similarly, a surge in borrowing to buy stocks, known as margin debt, can point to unsustainable speculation. And when everyday people start chasing meme stocks or pouring money into unproven companies, it's a sign that caution is warranted. But knowing these signals is only part of the equation. The real key lies in positioning your portfolio so that you're not caught off guard. Diversification is your first line of defense. This means spreading your investments across different asset classes, such as stocks, bonds, cash, real estate, and even commodities like gold. Each of these behaves differently during periods of turmoil. While stocks may tumble, bonds, especially high-quality government securities, often hold their value or even rise. Cash provides flexibility, allowing you to take advantage of opportunities when prices are low. And historically, assets like gold have served as a hedge against inflation and currency risk. Another crucial element is risk management. If you're an active trader, tools like stop-loss orders can help you limit your downside if a stock moves against you. Hedging strategies, such as buying put options or using inverse exchange-traded funds, offer ways to profit when markets fall. However, these strategies require a solid understanding of how they work and should be used with care. For most investors, simply avoiding excessive leverage, that is, not borrowing too much to invest, is one of the safest ways to reduce risk. Maintaining a portion of your portfolio in cash or cash equivalents is another smart move. This so-called dry powder gives you the ability to buy when others are forced to sell. Legendary investors like Warren Buffett have long espoused the value of having cash on hand during market panics, as it allows you to purchase quality assets at bargain prices. Patience, in this context, is not just a virtue, it's a strategy. While protecting your assets is important, you also want to be positioned for long-term growth. That means focusing on investments with strong fundamentals, companies with solid balance sheets, predictable cash flows, and competitive advantages. During turbulent times, these businesses are more likely to survive and thrive when the dust settles. Avoid chasing the latest fads or hyped-up sectors, as these are often the first to fall when sentiment shifts. It's also wise to regularly review your portfolio and rebalance as needed. Over time, some investments will outperform others, causing your allocation to drift from your original targets. By periodically selling a portion of your winners and reinvesting in laggards, you maintain your desired risk profile and avoid becoming overexposed to any single asset or sector. Behavioral discipline is perhaps the most difficult, yet most important aspect of a defensive strategy. Market crashes are emotionally charged events. The sight of plunging prices and alarmist headlines can trigger panic, leading even seasoned investors to make impulsive decisions. To counter this, Have a written investment plan that outlines your goals, risk tolerance, and the steps you'll take during a downturn. This plan serves as an anchor, helping you stay focused when emotions run high. Practicing mindfulness, such as taking a step back, breathing, and reflecting before making decisions, can also help you avoid costly mistakes. If you find yourself tempted to sell everything in a panic, or conversely, to double down on risky bets, pause and review your plan. History shows that those who remain calm and stick to their strategy are more likely to succeed over the long term. Let's put these ideas into action by outlining a sample defensive portfolio strategy suitable for volatile times. Start by dividing your portfolio into core and satellite holdings. The core should consist of broadly diversified, low-cost index funds or exchange-traded funds, ETFs, that track the overall market. These provide exposure to a wide range of companies and help smooth out the impact of individual losers. For added stability, allocate a significant portion, perhaps 30% to 40%, to high-quality bonds, such as U.S. Treasuries or investment-grade corporate debt. These typically provide steady income and help cushion losses when stocks fall. Next, consider your satellite holdings. This is where you can add uncorrelated assets like gold, real estate, or even alternative investments such as infrastructure or commodities. These don't always move in sync with traditional stocks and bonds, providing an additional layer of protection. Keep these allocations modest, perhaps 10% to 20% in total, so that your portfolio remains balanced. Maintain a cash reserve of at least 5% to 10%. This can be held in a high-yield savings account or money market fund, ready to deploy when opportunities arise. Review your overall allocation at least once a year or more frequently during periods of extreme volatility. If you notice that stocks have surged and now make up a much larger share of your portfolio, rebalance by selling some stocks and adding to your safer holdings. For those who want to take a more active approach, consider adding hedges. For example, you could buy put options on a market index, which increase in value if the market drops. Alternatively, inverse ETFs rise when the market falls, but be aware that these are best used for short-term protection and can carry risks if held for long periods. Finally, keep your emotions in check by setting rules for when to buy and sell. For instance, you might decide to only buy more stocks if the market falls by a certain percentage, or to trim your exposure if valuations become excessively high. Having these rules in place ahead of time removes the guesswork during periods of uncertainty. Remember, no strategy can eliminate risk entirely, but by diversifying, managing your exposure, and maintaining discipline, you substantially increase your odds of weathering the storm. The most successful investors are not those who avoid downturns altogether, but those who have a plan and stick to it, using volatility as both a shield and an opportunity. In summary, building a defensive investment strategy is about preparation, not prediction. Watch for warning indicators like yield curve inversions, excessive speculation, and rising credit spreads. Diversify your assets, manage risk, and keep cash on hand. Focus on quality and fundamentals, not the latest trend. And above all, stay disciplined, trusting your plan even when markets become turbulent. By following these principles, you'll be well positioned to protect your wealth and thrive, no matter what the future brings.